Hey everyone, welcome to the module of how do we actually make money. We would have explored previously how to buy a stock or an index fund, but how do we actually make money? So, in general, in brokerage accounts, there are typically two ways to make money. One is going long and one is going short. So, going long is when you buy and own an asset. So, this is what we'll mainly be doing. And short is pretty much the opposite. When you sell a stock without owning it, so you pretty much borrow a stock to sell it at the current price, and you promise to buy back the stock later and return it to the original owner. So let's go in a little bit more depth about this. So going long, as mentioned, is when you buy and own an asset. The point is that you get dividends from this. So this would be dividend paying stocks that let you reinvest back into it, and you earn an income from that, or you reinvest into it, or you let the asset appreciate. So, which means that you let the asset increase in price. So, if I go long on a share of Apple and it's worth $100, if that increases to $110, that's basically price appreciation. So, I can then sell it later for a profit. So, if I buy it at 100 and I sell it at 110, I make a profit of $10, right? This is pretty much the idea of what we'll be doing when it comes to long-term investing. So long-term buy and hold investing. So I want to buy an index fund of, let's say, the S&P 500 at the price of $1,000, and I want it to grow and accumulate so that in 13 years, instead of $1,000, it's now $13,000, and I sell it for the profit of $12,000, or I sell a small part of it, since that will basically be my sort of passive income that I'll be drawing on. Of course, you can sell only small parts of it if you want to live off of it, or if you want to sell large parts of it or all of it if you want to use it for a different investment or to buy a house or whatever you want. That's sort of the idea behind going long. So when you buy and own an asset and you sell it later, ideally for a higher price. Now, going short is pretty much the opposite. It's when you sell a stock without owning it. So what happens is you basically borrow a stock and sell it at the current price and promise to buy back the stock later and return it to the original owner. So let's say I'm me and I see a person called Janice. Janice owns a piece of Apple stock currently at $100. So I go to Janice and I borrow the stock from them. I immediately sell it into the market for $100 and now have $100 in cash. I promise that at some point I have to buy back the original share at whatever price it is and return it back to the original owner. So the point of this is that I hopefully expect the price of the stock to go down so I can buy the stock back at a lower price for a profit. So I pre-sell high and buy back cheap. So in this scenario with Janice, I sold the share of Apple for $100, and I wait for the price to go down to $80 if I think Apple is going to perform terribly, or if I really don't believe in Apple and what they're doing, or some scandal happens and I expect the price to continuously go down. I pre-sell it for $100. I wait till it's only $80 worth, and then I buy back the Apple share for $80, and then I give that share back to the person I borrowed it from. So I sold it for 100 and I bought it back for 80, which means I made a profit of $20. So that's basically the thinking behind short. It's pretty much the exact opposite of going long. So going long, a reminder, is when you want the price to go up and then you sell it for a profit. And short is when you pre-sell and you want the price to go down so you can buy back cheaper for a profit. So yeah, let's demo how to go long or short in the broker together. Pretty much it's gonna be super quick. Let's say I have a stock of Amazon. I can see, the overview of it here. I can see, its relevance to ESG, etc. I can see all the information I want about it. You will see here some analysis once, this is a demo account, so I don't have access to this, but once you deposit money and become a live full account, you'll have access to the research, but you can see here also the news, etc. Statistics, the revenue, PE ratio. This is PE ratio stands for price earnings ratio. So what the price of the company is versus the actual earnings or profitability of the company. Their market cap. So basically, what is the worth of the company, the returns, etc. Now, if I want to go long or short, I basically click this button here, trade. So if I'm confident in the company and I want to buy and hold on to it for the long term, make sure this is in buy mode, and then I buy whatever amount that I want and I click buy. If I want to do the opposite, I click on short. If I want the price to go down, I can click on this to short it. Pretty much this means once I click short, the price of a current $179, I want this price to go down. So right now it's at $179, and I think it should actually be $150 or $140. For whatever reason, I think Amazon is overvalued and I want the price to go down. I'll click short, and we would get a profit when the price goes down, since we'll be buying it back cheaper for them for what we sold it for. So that's pretty much how you do it. You just click short. I've now shorted Amazon, and I can always see my longs and my shorts. So here, I'm long on the S&P 500 and I'm short Amazon. So here we'll also see the current profit and loss values. So right now in this case, the Amazon price has gone slightly up since I bought it. Therefore, I'm currently in negative, since anytime when you're short, you still have to buy back the share later. So when you close your position or when you get out of it, let's say here, yeah, close all. If you want to close your position or you want to commit to the trade, and I want to now, okay, it has been going well for me and I just want to close, I can close trade, and pretty much that would close me out of the position. So now I'm closed out of it, which means I've pre-sold it for a certain price and I bought it back for a certain price. Same thing goes for if I'm going long here. The price is a little bit higher than what I originally bought it for. So now my value is up by $13. Let's say I want to now take my profit. Pretty much I would click then close here, close trade, boom, order received, and it should be closing in a few minutes. I would close my position. So I would have closed my long position, meaning I would sell at the current price, and I've made myself a profit of $13 since the price has increased a little bit since I bought it. And that's pretty much what you want when you're going long on something. So yeah, that's it. Now back to the presentation. So that's the two ways you make money, is by going long and going short. So buying low and selling high, or pre-selling high and buying back cheap. We obviously recommend sticking to way number one, which is going long. So buying and holding long term. Later on in this module, we'll explain the main strategies behind going long and short, but putting briefly, for passive investors, it is always best to go long and buy and hold for the best long-term value, since on the overall, on the average, especially with index funds or ETFs or anything broad, value appreciates or value increases over time. The economy grows, companies grow. So you generally want to be long. Shorting or active short-term trading, so even going long on something and then wanting to then go for those small price increases and then immediately selling. This is what's known as active trading or day trading, going for those short-term movements, going long and then closing the position within the same day or even the same weeks or even a few months, will cause you too much stress. And most people who aren't professionals lose money on this. So we really don't recommend active trading, and we also don't recommend shorting. So leave the shorting for professional traders or hedge funds, who this is their entire business, figuring out what companies are overpriced and then shorting them. So pre-selling at the current price and hoping that the price goes down. One thing to note, actually, regarding how much can you gain, or more specifically lose, when you go long or go short. If I were to, let's say, go long on a share of Apple and it's worth $100, the most I can lose if the Apple share completely collapses, it goes from 100 to zero. So I would have lost $100. But with short, it's the reverse. If it goes from $100 to $0, I've gained $100 in value, since I've pre-sold at 100 and I'm buying back at zero. But if it goes not my way, if the price increases to $200, I have now lost $100 because I sold it. I pre-sold it at $100 and I was forced to buy back at $200. So I'm making a negative $100. But if the price decides to go even higher up, let's say the price increases to $400, I am now at a minus of $300, since I pre-sold at $100. I was forced to buy back at $400, and yeah, negative $300. And this is the whole risk when it comes to short. If the price decides to suddenly go your way, there is theoretically no limit to how much you can lose. This is why on brokerage accounts like eToro, there are things such as take profit or stop loss. So for if things go too extreme, there are protections or limits in place. So not that suddenly one day you wake up to see in your account that your entire account balance has been wiped out because of one trade. Going short, this is something that should be left to professional traders and hedge funds. This is not something that we recommend. The entire point of this course is to help you invest sustainably, reliably, and for the long term. And going short is not that. What we recommend is going long. And yeah, that's basically it. So see you in the next video.